For weeks, the market has been deceptively quiet. Bitcoin's price action has been a flatline, a tedious crawl sideways that has lulled most observers into a state of apathy. The excitement has faded, replaced by a collective sigh of boredom. But this stillness is a mirage. What you are witnessing is not stagnation. It is the buildup of immense kinetic potential, a period of historic compression. Bitcoin is not moving because it's preparing to explode. Right now, its price is being coiled like a powerful spring, tightened by a confluence of three immense forces. First, the relentless pressure of a fragile global macro environment. Sovereign debt is spiraling, currencies are being devalued, and geopolitical instability is creating deep fractures in the traditional financial system. This uncertainty is quietly funneling attention and capital towards non-sovereign alternatives. Second, we are seeing the most significant institutional accumulation in history. While retail traders are distracted, large, patient capital, through new instruments like ETFs, is systematically absorbing every available Satoshi, quietly taking supply off the market. This isn't the frantic buying of a bull run, it's the calculated positioning of smart money preparing for a paradigm shift. And third, the technicals are screaming. We are currently witnessing one of the tightest volatility coils in Bitcoin's entire existence. Historical volatility has collapsed to levels that have preceded every major parabolic advance in the asset's history. This is the market's final, deep breath before the plunge. The structure is primed, the fuel has been loaded, and the pressure is now reaching a critical breaking point. When this spring finally uncoils, the resulting move will not be subtle. It won't be a gradual climb. It will be a violent, explosive repricing that will liquidate shorts, trigger a global wave of FOMO, and dominate financial headlines for months. What is coming is a move of historic magnitude. In the theater of global finance, the script is being rewritten. We've witnessed a series of seismic macro shocks, each a test of the global financial system's resilience. Consider the Maduro shock in Venezuela, an event that sent ripples through energy markets and triggered regional instability. Then, the sudden, sharp escalation of tensions in the Middle East, a classic risk-off catalyst. We saw a sovereign debt scare in Europe, threatening to unravel the continent's financial fabric and sending bond yields soaring. Simultaneously, a sophisticated cyber attack targeted the core infrastructure of a major financial hub, exposing the fragility of our centralized digital ledgers. In response to these events, the market's reaction was predictable, almost Pavlovian. Gold moved, fulfilling its ancient role as a haven. Equities tumbled as investors fled from risk. Oil spiked on geopolitical fears. Capital frantically searched for safety, for stability, for a hedge against the cascading uncertainty. And amidst this chaos, all eyes turned to Bitcoin, the new player on the macro stage. The expectation was volatility, a crash, a confirmation that it was just another risk asset. But Bitcoin didn't crash. It didn't even flinch. It simply absorbed the immense stress flowing through the global financial system. That is the signal. While other assets were whipsawed by fear and speculation, Bitcoin consolidated. It held its ground with the quiet confidence of a sovereign asset, its price action demonstrating a newfound maturity. This wasn't the speculative frenzy of past cycles. This was the behavior of an asset class preparing for a fundamental repricing, a store of value beginning to be treated as such on the world stage. On the technical front, the picture is one of immense pressure building beneath a critical ceiling. Bitcoin's price is currently pinned under a formidable supply wall, located squarely between $94,000 and $95,000. This isn't just a minor hurdle. It's a historically significant zone of resistance, where sellers have previously stepped in with force. What we're witnessing is a textbook case of volatility compression. Think of it like a spring being coiled tighter and tighter. The market's energy is being condensed into an increasingly narrow range. Key indicators confirm this consolidation. The Bollinger Bands are visibly tightening, signaling the squeeze is on. The Relative Strength Index, or RSI, has cooled off from overbought territory, now hovering neutrally, suggesting the market has taken a breath and is gathering strength. And perhaps most tellingly, trading volume has dried up, indicating a standoff. Neither bulls nor bears are willing to commit, creating a tense equilibrium before the inevitable break. Now let's add the fuel. Open interest, the total value of all outstanding futures contracts, is sitting at or near all-time highs. This means an unprecedented amount of capital is at stake, betting on the future direction of the price. This high OI acts as a powder keg. At the same time, the funding rate remains neutral. This is crucial. It tells us that despite the massive number of open positions, there isn't an extreme bias towards longs or shorts. The market isn't leaning dangerously to one side. Finally, we have the options market. A significant amount of gamma is stacked just above the key resistance level. In simple terms, if the price breaks above $95,000, options dealers will be forced to buy Bitcoin on the spot market to hedge their positions, creating a feedback loop of buying pressure. High open interest, neutral funding, and a gamma tripwire sitting just above a massive wall of sell orders. This is the precise, textbook environment where explosive, vertical price candles are born. The stage is set for a cascade. Samson Mow calls it the Omega Candle, a repricing event where Bitcoin doesn't climb, it teleports. A short squeeze meets ETF inflows meets sovereign-level narrative shock. Bitcoin is no longer a retail toy. It trades like a macro asset. BlackRock, sovereign funds, pension exposure, ETF pipelines, and now whispers of Bitcoin as a strategic reserve hedge in a fractured monetary world. Everyone is bored. Everyone thinks Bitcoin is stuck. That's exactly the emotional state that precedes violent repricing. Markets move when nobody is positioned for it. One catalyst, one macro headline, one rate pivot, one geopolitical escalation, one ETF flow spike, and the liquidity dam breaks. This is not hype. This is structure, compression, liquidity, narrative alignment. When Bitcoin finally escapes this range, it may not come back. If you want to be early, not emotional, and understand the macro forces shaping the next Bitcoin supercycle, subscribe. The coil is tightening.